Thank you for watching this preview video at xm.com. We'll be discussing upcoming U.S. data and the potential reaction in the dollar. I'm Maria Pachardevez, and joining me is Senior Investment Analyst Marios Hadjikyriacos. So Marios, the U.S. economy continues to show resilience. What are the current chances for a rate cut in March? And how might the upcoming GDP data for the fourth quarter impact the Fed's decision?
Certainly. Hello, Maria. So look, we've gotten a lot of very encouraging data out of the US economy lately. The year started with a very decent employment report, then we got a hotter than expected inflation report, then we got stronger retail sales, and overall the data suggests that the US economy remains quite robust. The labor market is still in good shape. So it doesn't seem like there's any urgency to cut rates immediately. And several Fed officials have argued the same point lately. They've stressed that the markets have gone maybe a little bit overboard with pricing in such heavy rate cuts. And they've also said that the actual pace of rate reductions is probably going to be slower than what traders expect. Now, as we speak, Maria, the prospect of a rate cut in March is now priced almost like a coin toss, so almost 50-50 on whether the Fed will cut interest rates in March. And therefore, the upcoming GDP data is going to be really important in tipping the scales in one direction, and that of course is going to drive the dollar. Now, in the fourth quarter, economists, Maria, expect the US economy to have grown by an annualized pace of 1.8%. Most of that is because of heavy government spending and very solid consumption trends. Now, the question is, if we see a surprise, is it more likely to be an upside surprise or a disappointment in the GDP data? And to that, I think the answer is it's more likely to be an upside surprise. And I base that on the Atlanta Fed GDP Now model. This is a model that attempts to track economic growth in real time. And this model currently estimates GDP growth at 2.4% instead, so much higher than the official forecast. And I should add that this model has a pretty solid track record in terms of predicting actual GDP numbers.
Turning to the dollar now, what's the short and longer term outlook?
Yeah, so look, if we get a stronger than expected GDP print and that leads investors to further unwind some bets for Fed rate cuts, that will probably be positive for the dollar. Now, the bigger outlook for the dollar, I think, is still quite positive. So we've seen the dollar recover quite a bit in recent weeks. Most of that came on the back of strong economic data, causing this rethink around how quickly the Fed is going to reduce interest rates. But looking ahead, Maria, I think the broader outlook for the dollar is still bright, mostly because of how strong the US economy is at this point. So the US economy is clearly in a better shape than other major regions like the Eurozone or China. So Europe might already be in a minor technical recession. So what does that mean? It means that economic growth differentials currently favor the United States. Therefore, there's a clear risk that the Fed might cut interest rates at a slower pace than the European Central Bank in this cycle. And that might be an element that supports the dollar. Now, historically speaking, Maria, the dollar often thrives in what we call late cycle environments. So, right before a global recession, perhaps, especially if at that point the US economy is healthier than the rest of the world, which is the case today. Now, a final point I want to make is that the massive rally that we've seen in the stock market in recent months has probably been negative for the dollar. So the dollar acts like a safe haven instrument. When the stock market goes up, demand for safe havens usually goes down. So the point here is that if we see the rally in stock markets lose some steam, that might be another element that helps the dollar to advance in the coming months.
Marios, thanks so much. This was a preview video here at xm.com.